Good morning and good afternoon. Welcome to the July 11th WASDE review webinar. Glad you can join us today. Hope it's not too hot wherever you are on this July day. My name is Greg Horstmeyer. I'm editor-in-chief at DTN, and I'll be your moderator for today's event. With me today, as usual, is our lead analyst, Rhett Montgomery. Rhett's going to walk us through the WASDE report numbers and discuss a little bit about what that means to the markets right now, as we're sitting here in the middle of the production season in the United States. As always, the audience for today's webinar is in listen only mode, but you can ask questions at any time. And I do encourage you to throw questions in as they come to you so that we can track them and gang them together if some people have the same question. You can do that by opening up the chat session or section. That's the little icon that looks like a cartoon balloon in your lower right-hand corner. If you click on that, that'll open up the chat box and you can type your questions into that. And at the end of the webinar, we'll get those to Rhett and we'll talk about those. Also, as always, this event is being recorded. A rebroadcast link will be available on the dtn.com website in 2 business days, so the first part of next week. You can go to dtn.com and find that and then share that or review it or share it with others in your operation. With that, we'll begin today's webinar. I'll turn everything over to Rhett. Rhett, looked like markets dipped a little bit right after the WASDE announcements. Where are we now?
Yes, good afternoon. Thank you, Greg. Good afternoon, everybody. Thank you for joining us here for the latest edition of our WASDE webinar. As Greg mentioned, kind of a mixed tone to these estimates today from the USDA. I'd say more or less a slightly bullish flavor across the corn and wheat markets, maybe slightly bearish on soybeans, but unfortunately, jumping into here, the post-report markets are drifting slightly lower. We're down as we speak about 4 cents on December corn. We have November soybeans down about 5 cents, and September wheat markets down about 8 to 9 cents on the winter variety and winter wheat prices, spring wheat prices down double digits, a little over 12 cents right now. So it seems like the market's continuing to be focused on the friendly weather that we'll touch on. But first, let's go into these fresh USDA estimates. As always, we'll kick it off with corn here. On the corn side here, a number of changes for the USDA, mainly to the old crop side of things that flowed into the new crop balance sheet starting in 2024-25. As you can see, the thing that jumps out right away is we did get a 100 million bushel increase to their export figure. We had been trending in total commitments well above the 2650. That was the prior estimate. So it was due for them to increase this. That 2.75 billion bushels will be a record export number or export performance for the U.S. if achieved by the end of the marketing season here, with about 2 months left to go, just under. So unfortunately, that was partially offset by less feed demand from the USDA. They lowered that number to 5.675 for the feed and residual bucket here in this morning's numbers. So the resulting flow through to the ending stocks for old crop was a reduction of 25 million bushels down to 1.34 billion bushels of corn stocks left over, or estimated to be left over here at the end of the summer. How that flowed into the new crop, of course, starting out, we do have slightly less acreage in accordance to the June 30th report, 95.2 million acres of corn. And as expected, USDA left their estimate for yield unchanged in the July WASDE, which was predicted. It's very rare that they change that estimate, given what we know currently about the growing season. Still a lot of growing weather to go. But that lower acreage did have a bottom line impact to production. It cut production from 15,820 down to 15,705 billion bushels. That is still a record crop if true, but steadying with about 115 million bushels less production as estimated. Down the curve in demand, the cut to feed and residual, the bearish cut, did flow into new crop as well. They are anticipating 50 million bushels less feed and residual as compared to a month ago. And so then going down, that softened the blow a little bit on the cut to the ending stocks, which end up at 1.66 billion bushels as compared to 1.75 billion bushels a month ago. So overall, pretty bullish in the directional cuts, with cuts to both old and new crop stocks. The issue we're seeing in the markets right now, I believe, is that it's just a matter of if traders believe that yield estimate. Most traders at this point penciling in above trend yield, just given the weather and the crop conditions thus far. But it should be mentioned that we haven't hit the trend or beat the trend in the past 6 years for U.S. corn. So I think there will be part of the market at least that remains skeptical, and will kind of believe it when they see it. So moving on to the world outlook here. Probably the most notable change from the USDA for the old crop was a bump in Brazil's production up to 132 million metric tons. CONAB in Brazil, in their report yesterday, said the same. They put it as 132 million metric tons as well. So we're right in line and in agreement with what the local agency is saying in Brazil. How that flowed through. For the old crop stocks, we had a reduction here, a slight reduction from 285 million metric tons to 284.18 for the entire world. So that mainly was driven by a reduction in Chinese stocks, which was flowed mainly as a reduction in imports received in China. So looking at the world situation without China, we did see a slight growth in old crop stocks, mainly again as a result of that higher use or higher production in Brazil than originally anticipated. Looking at the new crop situation for corn into 2025-26, that is, flowing down here, as you can see the changes from June to July, penciling slightly less production for the world. That'll be driven primarily at this point by the United States due to that cut in acreage, as you can see a couple lines down. Otherwise, going through the curve, really not many big changes. Demand is expected to stay pretty much steady, as is world trade. So the result there was about a 3 million metric ton cut to ending stocks for the entire world, including China. Not including China was a similar cut, 94 million metric tons down to about just under 93 million metric tons. That was offset slightly by an increase in stocks in Brazil. The most notable thing there is their beginning stocks increased by that 2 million metric tons. They are penciling, and something to watch moving forward is the total usage in Brazil, especially for industrial usage. At least part of that increased production is expected to go to the growing ethanol industry in Brazil. So something to keep an eye on, not necessarily going to mean a whole lot more exports for Brazil or a whole lot more competition. The domestic use certainly matters a whole lot when looking at it from that lens. Otherwise, for China here for next year, the production number stayed flat at 295 million metric tons, 321 million metric tons of use. They are projecting less stocks, and that's a product of less beginning stocks due to the less imports for the old crop season. Just graphically looking at world corn supplies, again, not including China in this number. As you can see, we are expected in 25 and 26 to grow corn supplies, not including China. Again, this was maybe perceived as bearish to the market here today, that we're even with that, steady yield in the U.S. and a cut in U.S. production, obviously above Brazil, the most important player or producer of corn in the world is the U.S. So maybe a little bit of a bearish twist to see that even with less U.S. production, still penciling in a growth in stocks for the next year. So something to keep an eye on. Obviously, we're really early on those South American estimates, and a lot of other countries that are just now finishing up their 2024-25 production. So but something to keep an eye on here. And overall, you can see though, since the mid 2016, 2017, we are gradually trending lower on that as demand for corn continues to grow at a very healthy clip throughout the world. Looking at U.S. corn exports, as mentioned, the USDA's new estimate of 2.75 billion bushels would be a record if achieved. As of July 3rd, the most recent Foreign Agricultural Service data, we are at 2.28 billion bushels of corn exports. That's up 29% from a year ago. As you can see on the graph here, the green line is our current year. We're really just neck and neck with that dotted red line, which is the previous record year set in 2020, 2021. We've slipped below the pace over March to June, but we had plenty of weeks back, as you can see, October through the end of 2024, where we were trending above that year. So it's all offset or evened out over that period to where, as mentioned, we're very close. It's going to be a photo finish, I imagine, depending on how we trend here. As obviously, as you can see, both that year in 2021 as well as the 5-year average, you expect to see your shipments begin to dwindle here into late summer on increased competition, from South America. The thing in the favor of the U.S. this year is certainly the price competitiveness, both a weaker U.S. dollar relative to last year, as well as just a overall inexpensive corn price due to the price drop throughout June and July thus far. So expected to be very close, but certainly an impressive run thus far for U.S. corn exports. Looking at ethanol production, the USDA kept their estimate for 2024-25 unchanged today at 5.5 billion bushels. Ethanol margins are what I would call steady, as you can see from about May through most of June. Pretty steady, right around anywhere from 50 cents to 70 cents in net margin. I will say that it is quite a bit lower than it was in the summer of 2024 when we were sitting anywhere from north of $1.25 or so. So something to keep an eye on there. But overall, it doesn't seem to have mattered a whole lot to incentivizing ethanol production. We're still set to produce 3.7% more ethanol in the U.S. this year than we did last year. The unfortunate side of that is it's not equating 1-to-1 in more corn usage. Currently, only a fraction of a percent ahead on corn production or corn grind used for ethanol production. So I am a little more bearish just personally than the USDA on that figure. I'm closer to 5.45 billion bushels or something in that range. So something to keep an eye on for future USDA reports as we get through the summer, which has a wide variability in ethanol production historically. Quickly looking at corn basis, as you can see, the September corn basis has really struggled since spring to gain a footing, pretty much continually drifting lower, mainly driven by the July to September futures spread. Had a very impressive collapse. It was at one point about a 40-cent inverse, and I believe it rolled off. Or I guess the July is still trading here in delivery window, but it's so you can't really put a whole lot of stock in the spread because weird things can happen there. But it had fallen all the way down to basically even money from that 40-cent inverse. So basically the market signaling through that the initial fears of a short supply come summertime were really alleviated by that better than expected Brazilian crop. And as a result of less feed and other buckets in the U.S. as well, we're just not seeing the crucial bidding up for corn that we maybe would have expected back in February or something. So it makes me a little nervous here as we move into the late summer that perhaps we're going to see further reductions in the old crop balance sheet for the demand side and maybe end up bringing that ending stocks number closer to what was the previous estimate or even higher by when the time all is said and done. Looking at non-commercial trader positions, as you can see, since we're right around February or so when we hit our peak, it's been a really steady sell-off. Only a few in April there was a brief pause there where they returned to buying, but really since then just continue to pile into shorts. We're really going to be looking to challenge that record that was set. Maybe not the record set in early 2024, but it seems like the mid-summer 2024 is the target. It's a similar year, I would say, all in all to 2024. It just seems like a more or less friendly weather outlook, has most traders at this point expecting a higher than trend yield, as mentioned previously. And that's in turn incentivizing, or giving little incentive, to say it the other way, it's giving little incentive to traders to break their recent bias and begin covering their shorts just yet. So as of July 1, just over 150,000 contracts net short, and that record there, you'd be looking at more in the 270 or so thousand. So it's starting to be within arm's length of the trade here. So something to keep an eye on. I just wanted to add this. This certainly seems to be the thing that's driving the bearish action in corn futures and soybean futures, for that matter. And I expect it's why we're not really getting much of a boost despite bullish directional changes for corn today. As you can see, a lot of rain forecasted for the eastern corn belt and drifting even into the west here through the 25th of July. That's going to cover a good majority of the corn pollination window for 2025. And to go with this, it's not on this graph, but to go with this, we are expecting a moderate temperatures too, mostly average across the far east and west. But there's I believe in the 6 to 10 day window, there's a big area over the central part of the U.S. that's going to expect cooler than average temperatures. So cooler than average with a lot of rain. Certainly looking non-threatening right now to get the U.S. corn crop through pollination with very little issues, and the soybean crop through blooming as well. So I think this is what's weighing on the markets for the last few weeks, certainly, but also today as we head into the weekend. Jumping to soybeans here, kind of a busy day for the USDA on the soybean balance sheet. The USDA did, looking at demand for old crop, add 15 million bushels of exports to that estimate. Just this last week, as of July 3rd, the commitments surpassed the 1.85 previous estimate. So the USDA their hand was forced here to increase that, but they did, as was kind of feared, reduce residual usage by 15 million bushels to keep the ending stocks number unchanged at 350 million bushels. I think that was really driven by their findings on June 30th of still north of 1 billion bushels of soybeans that were left on hand as of June 1st. I really think it kind of comes down to maybe we just had more supply to begin with for this year. It's possible that the production, whether it was, they were off slightly on acreage, maybe they were off slightly on the yield, but it sure seems like currently, given this switch around here and just jostling in demand, whenever the residual bucket kind of pops its head up, I always revert to thinking they probably missed on an earlier estimate, notably on the production side. So something to keep an eye on as we move down the curve. But for now, anyway, flowed into the new crop balance sheet. As you can see, less acreage as was expected due to the June 30th report. That did, of course, lead to a very marginally decrease in production, but still overall a decent soybean crop on tap for 2025. And then the big changes were the shift in demand. So as you can see, the USDA very bearish on their changes for new crop exports. We'll talk about this in further detail momentarily, but I'm a little skeptical on this, just given how early it is. I understand their concerns, given China is still absent, and the relationship with China certainly isn't the best currently, as is the relationship with a lot of trade partners, which has taken certainly a boost in anxiety over the last couple of weeks with the impending tariff deadline, which was supposed to be July 9th, now August 1st. So But in good news, the USDA did soften that blow a little bit by adding 50 million bushels to the crush program. So that's looking like a very, very strong crush number. As you can see, 120 million bushels more expected in 25 and 26. And that might be driven partly by the friendly biofuel news that's hit the markets over the last month or so, both the EPA guidance, which was above what was initially expected for mandated biofuel production, and then also the passage of the spending bill included some tax incentives on that front as well. So overall, just a bit of a shift. But unfortunately, for the bottom line, it did increase our ending stocks estimate for the new crop to 295 up to 310 million bushels. So still expecting a stocks decline year over year, but it's going to be a lot of it will be hinging on that record yield. If we slip from that record yield by August, we'll quickly still be back into a fairly bullish territory, I would say, for soybeans, but time will tell on that. Looking at world soybean numbers here, not a lot to speak of on the old crop side. We did get a slight increase in Argentine production. The bottom line change for the world stocks was slightly more stocks than expected at 125.12 million metric tons. That was up from 124.2 in the June report. Looking down, that's mainly driven by the Brazilian changes. They basically took imports out of China and took exports out of Brazil to shuffle that around. So overall, expecting higher stocks in Brazil as a result of just less export demand for the old crop soybean. Jumping to new crop 25-26 soybeans. Again, driven primarily by those changes to Brazil, which simply flowed through. The higher stocks just flowed through to the new crop season as well. And that, as a result, did push the world stocks without China up just over 2 million metric tons. The new crop season, 126.07 million metric tons for the entire world. That was just slightly above the average trade estimate heading into the report. So pretty neutral overall, I would say, on that side of things. Looking at soybean exports, as mentioned, USDA added 50 million bushels to this, now expecting a 10% increase year over year in soybean exports. As of the most recent Foreign Agricultural Service data, we were up about 12% on shipments. So we're right in line with to hit that increased estimate. We had 1.67 billion bushels of shipments thus far as of July 3rd. So as you can see, over July and August, as indicated by the blue and green dotted lines, you do expect to see a little bit of a late season boost out of the export book, and we'll look for the red line to continue on close to those. Really, the blue line is what we're watching, the 5-year average. If we get that late season boost, then we should, in my mind, have no problem hitting this increased estimate for soybean exports in the old crop season. Looking at new crop exports, as mentioned, the USDA pretty bearish with a 70 million bushel cut to new crop export expectations. The reason why I mentioned that I thought it was maybe a little unfair given where we're at is just looking at that dotted blue line. You can see that we're still on pace as compared to last year to minimize the damage. I understand the anxiety that China hasn't bought any beans yet. We are past the period where they did last year. They bought their first beans the week ending July 4th of last year. So, but looking at that blue line compared to the red line, we're right on pace. We're actually slightly ahead. So really what will matter to me is what happens in late July and August. Do we see that sharp increase that we saw last year? And you see most years from 20, looking at that 10-year average, you always expect in late July and August for that to really take off. So do we see that, or do we see it, is it put off until September, or does it never arrive at all here without China? So that's really what's going to matter. I'm a little too early here personally to call it a lost cause quite yet. but I do understand the anxiety, especially given the strong, record strong Brazilian crop, probably pushing off the demand in the U.S. a little bit this year as compared to last year. Looking at soybean crush, as mentioned, really bullish on the new crop, but this is a look at old crop. As you can see, we still have roughly $3 of gross margin at the end of June. So there's a lot of incentive in there in the market with the rally in soybean oil, even with the sharp sell-off in soybean meal. It should be mentioned we're still having a really impressive board crush and a lot of incentive to keep at the record pace for soybean crush. So season to date, we are 5.9% above a year ago. USDA kept their estimate unchanged at 2.42. I do have a couple different models of my own here. I will say that the thin dot, the top line, the one with the thinner dots, is the one I'm kind of erring to the side of. The other one is based on more of a 10-year historical seasonality, which I just don't know if the historicals really matter a whole lot right now, to be fair, given just how strong, in record setting we've been on crush. I am erring to that second model, which just to, for what it's worth, my personal estimate is for 2.435 billion bushels in 2024-25. So I'm a little more bullish than the USDA on crush here as we head into late summer. Looking at the soybean basis here, as you can see, in the last few days, we've really had a strong uptick in recovery in the basis after a kind of a disappointing June, especially through the roll from the July board onto the August board. Gave up a little bit of value there, but we have since recovered. Overall, pretty much right in the middle of the group, but it'll be important to keep an eye on this as we move through late summer to kind of gauge how strong our fourth quarter demand is going to be for soybeans. Lastly, jumping to wheat. Again, a lot of changes for the wheat balance sheet, a busy day for the USDA. Firstly, starting with the 24-25 season, it should be noted that ending stocks were raised to 851 million bushels in accordance to the June 30th findings. I was surprised to see the exports for the old crop season at 826 million bushels. That's about 20 million bushels higher than the Census Bureau had in their findings here in early July. So, and that's, we were 776 in weekly data of shipments when we hit the cutoff at the end of May. So overall, in their final accounting, they found about 50 million bushels or so that wasn't included in your weekly reports throughout the marketing year. So kind of a bullish development there. As it flowed into new crop, though, as mentioned, slightly more stocks, slightly more wheat production, which was surprising here. I was expecting a decline, and we'll talk about it in more detail, but we did get a decline in winter wheat, but it was offset by an increased estimate for spring wheat and durum production. So flowing down there, as you can see, bullish on the exports for 25-26. They did give us 25 million bushels more exports, which was interesting as well. We're kind of right in line with last season. So, I'll take it, to put it that way. I'm a little skeptical given just we're kind of fading on sales, it seems like, in the last month or so. But overall, the bottom line was with that increase in demand, we did reduce our ending stocks estimate to 890 million bushels as compared to 898 for the new crop season in last month's estimates. Quickly looking at the world side of things, a little bullish in the numbers here today from the USDA, less stocks than were expected. As you can see, it's really being driven by they are expecting more domestic use for wheat, but really less trade. We're not expecting as much wheat to be imported and not as much to be exported. So expecting more production, I guess, in the areas that use their wheat, and more kind of I'd call it hand to mouth production, where we're just going to be producing where it's needed. So looking at some key countries, notable to see Canada be decreased by 1 million metric ton. That's much more in line with the Agri-Food Canada's findings in their most recent report at the end of June. Otherwise, as expected as well, strong crops expected in the European Union and way better than early expected in Russia. The 83.5 million metric ton will be much higher than many were expecting back in January or February when it was so dry. But that, of course, does lead to more exports for Russia as well. And then lastly, I was a bit surprised to see China's production left unchanged at 142 million metric tons. I have heard rumors that the drought was much more significant than we're hearing, but obviously the USDA isn't seeing enough currently to change that. So looking at world wheat supply and demand here, the big takeaway here is that, wheat stocks relative to wheat demand, if you take out India and China, which are the world's largest wheat stocks holders, or largest producers, I should say, but don't export a lot. So they're trapped stocks. They're never going to see the world market. We are going to see the third straight yearly decline. So perhaps this does down the road open up the door for more export business. But for now, anyway, as mentioned, it doesn't seem like the market seems to care. It seems like the market's satisfied that where wheat is needed, it'll have no problem being found. So moving on to the winter wheat, jumping into the numbers by variety. So we did have a 35 million bushel cut to the winter wheat crop, really across all three varieties. The kind of bears thing was the offsetting increase or above what was expected for spring wheat. So still expecting 503 million bushels. That is down from 2024, but that is slightly higher than what was being anticipated in the June reports. And then Durham, of course, very steady at 80 million bushels. So mixed overall for wheat. We expected the winter wheat production to be less on less harvested acres mainly, but a little, interesting to see. There's, still expecting a fairly strong spring wheat crop, especially given, some of the issues in Montana and the Northwest areas with drought. Looking at winter wheat basis here, as you can see, a very sharp increase in the hard red basis, really towards the end of June and into July. I believe our basis analyst, Mary Kennedy, told me that was kind of a quality move due to some of the late rains maybe impacting the protein qualities throughout the southern plains in the U.S. But overall, right in the middle of the 10-year range. But we are slowly but surely firming here. Something to keep an eye on here. We are over 50% harvested in the U.S. winter wheat crop as of last week. So as you get through the home stretch of harvest here, it'll be interesting to see how the basis reacts here to the incoming supply for hard red winter wheat. Looking at wheat non-commercials here, as you can see over the last really 2 months or so, not quite 2 months, we've had a rapid short covering episode for across the Kansas City, Chicago, and Minneapolis markets. It should be noted that this is as of July 1. We'll get the updated numbers this afternoon. So we most likely have turned the corner right there at the green line, which is a 1 standard deviation move from the 5-year average. And we've likely have a turn here and have built up some short positions again. So we'll have to see if, given today's data and given what feels like less wheat overall in the world and less wheat certainly in the U.S., if traders decide to try it record short again or make their way back towards that previous record. Otherwise, you can see even going back to 2 or 3 years, we haven't had much room for bullish bets in the wheat market. The last time we jumped to a bullish bet in the wheat market was back in mid 2023, and that, as you can see, was very brief. Really, since Russia first invaded Ukraine back in early 22, it's been slowly but surely adding to the bearish bets for wheat price here from the non-commercial side of things. In conclusion, apologize, ran a little long today, a lot to talk about, but take these with a grain of salt as well. When I reference something as bullish, I'm referencing the directional changes in the estimate, not necessarily how it's going to be perceived by the market. Are kind of two separate things, and it's more if the market believes what the USDA has to say today or not. And so far, it sure seems like they don't, or are very nervous that the production numbers, especially for the new crop seasons and corn and soybeans, aren't going to be true by the time it's all said and done. But that being said, I did see today's directional changes to corn as bullish. Record old crop exports and reduced stocks led to declines in the new crop stocks as well, and less world stocks than expected. On soybeans, I'd call it neutral to slightly bearish. Again, old crops stocks held, but the reduction to exports for the new crop was slightly bearish, but was offset by an extremely strong crush number. And then slightly higher world stocks as well as compared to what traders expected coming into the report. And then wheat, I'd call it neutral to slightly bullish. U.S. winter wheat production did decline, but was offset by higher spring production. I think there'll be some skepticism about that, especially if we don't see a reversal in the conditions across Montana and even into western North Dakota as well. We have some drought starting to form. So, and then overall, less world stocks than anticipated. It seems like there's just going to be a little less mobility in wheat through this year in terms of trade. So something to keep an eye on there. But overall, pretty, as I said, neutral to bullish on the grains and maybe, neutral to bearish on the oil seeds. So with that, our next USDA reports are on August 12th. I know Greg has some comments he'd like to make regarding a little bit of a change in the agenda here for next month. But with that, I think first we'll take some questions.
One of them was related to the question I was going to ask, which was that my question was, I was interested that USDA held, firm on the June farm gate price of 420 on corn. Seemed to be, again, a little bit more bullish on things than what you might be. The question that I'd asked that came in from the audience that's kind of related to that is, what's your view on when the floor is going to come in on this new crop? If this year is similar to last, do we put the floor in earlier in the season in August, or do we think that things may continue to go down as the combines roll?
Yeah, so I think that's a great question. I think, just given where we are on estimates, last year at this time we were penciling in a stocks number north of 2 billion bushels on new crop corn, and of course, due to that, we grinded lower on futures down to the, I believe, 380, 390 level in late August, before obviously at that point the forecast had turned very hot and dry through August and September and proved to be very detrimental to the yields. So it's really going to depend on that forecast. I know the long-term forecasts still continue to push off that hot and dry that we thought would be across June, July, and August. It's now been pushed off to, I think NOAA is still showing chances for a hotter, drier western corn belt, especially through August and September. So if that comes true, we might be sitting in a situation very similar. But overall, I think we're closer to the bottom than today's trade might indicate. I would be very surprised, just given the historicals, and again, given what we did last year, just as a comparison, if we really traded much lower than $4 to $3.90 on new crop December corn. That being said, in terms of an absolute bearish target, looking at like a weekly chart, a 2 standard deviation move from the 5-year average would put it roughly down at like a 390 to 380. So that would be, kind of my long-term bearish target here for late summer if we don't see a shift in the forecast. But that being said, if we do end up beating the trend and significantly, it could certainly get a little more bearish than that if we start adding a whole lot to that production number.
Yeah, we've seen some private estimates come in pretty high on those corn numbers, haven't we?
Yeah, absolutely. Again, I'm always skeptical to, a lot of these models this time of year are based off the weekly USDA crop condition ratings. And I think we shared last month a chart that showed that, basically there's not a whole lot of historical reliance between a really high early July good to excellent rating for the corn crop and the final yield. We've had years where it's been 75%, good to excellent, and the yield has been, in the mid, 175 or so. Of course, back in the late 2000s when that happened, that was closer to the trend. We're continuing to add to that trend year in and year out. But, that being said, I think what really matters obviously is the weather, which, you can't deny thus far through the growing season. It's been mostly non-threatening. There are some areas potentially in the east. Illinois was developing some drought, but again, it's gotten a shot of rain just in the past 24 hours that will probably help to alleviate some of that concern. So, yeah, looking good thus far. It's hard to argue against above trend currently, but there's still a long ways to go. August and September maybe don't matter as much as late July, but they still matter in terms of finishing out the crop, as we found out last year.
Yeah. The other question came in is that as you noted at the top here, that the market's reaction to today's report was down for all grains. Do you think that's going to hold for the next week?
Yeah, so I think it's hard to say. It's hard to answer that, but I think I'll put it this way: the next few days are going to be very telling on how much stock is getting put into these numbers by the USDA. I imagine we're probably just going to go straight back to a weather trade. I really think the issue is that traders currently just don't believe the yields are going to stay unchanged. I think they were anticipating those yields to be unchanged just because that's typically what happens in the July WASDE. So I think they're already probably looking ahead to the August report, which will, of course, include some yield or some field data rather than a strictly numbers based or mathematical model. It actually will include some test plot data. So I think we're going to see that traders are quickly looking forward to that and keeping the bearish pressure on prices. But that being said, the technical standpoint I still think matters to where we're certainly oversold here to some degree, and it's felt like in the last few days anyway, like we're feeling for a floor to at least have a short-term bounce back up towards maybe the moving averages on the charts. But again, whether it's a sustained rally beyond that, I think it's going to be difficult currently given the weather outlook.
I appreciate that. Well, I want to thank everyone for joining the conference today. As a reminder, it's been recorded and the rebroadcast link will be up on the dtn.com website within about 2 business days. You can go to the events section where you were registered for this event. I also want to apologize. A couple of you noted that you didn't get an email with the link to this webinar and had to sign in as guests this morning. I apologize for that. We've been having some issues between the platform that we use, this WebEx platform that we use, and our emailing software. And sometimes all the emails that we put into the box don't come out the other end. So we'll look into that, and please bear with us as we try to fix the technical gremlins. In addition to the questions you asked today, if you have more questions, Rhett's email is up there. You can send those questions to him. I also encourage you to visit the dtnpf.com website where you can pick up on the daily news that we've got going on there. As Rhett said, our next webinar is August the 12th with that WASDE report. That is on a Tuesday. That's going to be in the middle of the week of our DTN digital yield tour that we do every year. We'll be going through our weather models and our production models and making some predictions in states across the Corn Belt. And when the WASDE comes up, we'll be able to compare what we're seeing in our weather models with what USDA says and what others say. So watch for the lead up to that. You can see more about that on the dtnpf.com website, or if you're a subscriber, you can see it with your paid product, either on online or on satellite. I'd also note, just for those of you who've been around a while, the August webinar will feature analysis from a voice from the past. Todd Holtman, our lead analyst emeritus, who retired mid-year last year, will be back to walk us through the August report. Rhett and his family are going to take a well-earned vacation, one that was scheduled quite some time ago. So Rhett's going to be out of the country during that, and Todd has graciously offered to come step in and visit with us about what he thinks is going on there. So you'll get a chance to hear Todd's voice again if you've been with us for a while. So with all that, again, you can register for that August webinar at dtn.com at the resources events page. I'd encourage you to do that quickly. If you have any troubles registering, or if you have other issues, my email, I don't have it up here, but it's greg.horstmeyer@dtn.com. You can find me on the dtnpf.com website. Send me an email. Let me know if you're having troubles, because we are walking through some changes with this platform, and sometimes things don't work out right. With that said, thanks again for joining. Great questions, good discussion. Appreciate everyone's attention today, and have a safe and hopefully relatively cool weekend. So thank you from DTN.